Government shutdown risk aside, my next guest says in the near term, macro fundamentals will support the markets from here. Let's bring in Dan Suzuki. He's Deputy CIO at Richard Bernstein Advisors. Dan, it's good to see you. Welcome.
Great to see you, Kelly, always.
And I should have emphasized that Maya McGinnis's position was that she doesn't expect a shutdown this week, maybe more of a January, February issue now if they can get this resolved. What does that mean to you for how markets perform into year end?
You know, Kelly, I don't think it really makes a huge difference. Obviously, you know, it has a big impact on sentiment and has a very near-term impact on sort of the economy. But as we've seen time and time again, you know, you take what you take away, you get back, you know, as soon as the resolution hits. So I think it's really more of a timing shift, which if you're thinking about equity investors and profits and discounting future results, it really doesn't make a huge difference, but it does shift the timing, you know, potentially into next year. So I think, you know, if you get a resolution in the near term, I think, you know, there's no reason that the markets can't continue to rally and focus on the actual fundamentals of improving profits, you know, slightly improving liquidity and huge opportunities within the market.
And tell me about that. I need to be convinced today at a time when I'm still looking through all the unemployment rate metrics and different kinds of possible recession triggers that are out there, how you guys can look at the fundamentals and feel really good about it.
Well, I think first thing to point out, Kelly, is I'm sure you're aware, is that there's already a huge divergence between, you know, what's happening with the economy and what's happening with corporate profits. You know, the economy has been chugging along like, you know, everything's healthy, whereas corporate profits have been in a corporate profits recession. I mean, third quarter is going to be the first quarter of positive growth that we've seen in some time. And so to that extent, corporate profits have already felt a lot of the pain and things are getting less bad and in that process of well into the recovery. Whereas the economy, which is much more sensitive to the U.S. consumer, is slowly and gradually starting to slow. But I think the ultimate level of balance sheets and incomes are such that it's going to take a while to turn that super tanker around to get the economy to actually fall into recession. So not that it's not going to happen, but it's just not going to happen imminently.
So you guys think the profits recovery is underway and should provide strong support for cheap cyclicality. Where in particular do you think would be the most attractive parts of the market now? And then what's kind of your general price target for the S&P?
Yeah, Kelly, well, I'll answer the second part first. I mean, the best part of not being a sell-side strategist anymore is I don't have to come up with an S&P target because I think it's a bit meaningless. You know, on the buy side, as an investor, you're really focused on, you know, higher or lower. I think, as I said, in the very near term, you know, risks are to the upside. What's the best way to play that? Well, profits are indeed recovering and liquidity is ample. You know, what are the cheap areas of cyclicality out there? I think energy and industrials are probably, you know, some of the better ways to play that. They're more late cyclical sectors, late economically cyclical sectors. But I think in barbelling that with some defensive, high quality areas like healthcare, you know, also makes some sense given where we are.
What would it take for you guys to change your tune and say, you know, are you watching things like the labor market data? Would it be, you know, I think we only have kind of the retail portion of earnings season to work through. What would be your trigger points for a change in outlook?
Yeah, I think the biggest risk to the near term, Kelly, is that of, and everybody's focused on this right now, is that of credit and liquidity. Right now, you're starting to feel the pain trickle through on the lower end of businesses and households. But you know, most households and most businesses are actually still quite healthy. I think to see, you know, a dent in that recovery, you really have to see that broaden out and become a bigger problem. I just don't see that happening right now because not a lot of companies and not a lot of households are refinancing at these much higher rates yet.